is up, everybody, and welcome back to the Fresh Finance Podcast. My name is Thomas Elms. I've got my co-host here, as always, Kyle Ryan. And today we are going to break down kind of real life understanding, simplified explanations of insurance. So today we're really just going to focus on life insurance and disability insurance. I think this is kind of a key topic right now, as we're starting to even kind of have the recession conversation again. And essentially kind of where this plays in is just recognizing where you're vulnerable, Kyle. And I think that kind of where people are vulnerable is loss of income and loss of life, right? Loss of life is kind of a given. But from a planning perspective, those two events are very important to recognize are a possibility, and finding out the most adequate ways to essentially kind of cover that risk through the form of insurance is really important. And, like I said, we're going to talk primarily on the life and the disability side. We're going to hit a little bit on the end towards business owners and some strategies that they can consider as well, because the way that they have to approach it is a little bit different. But Kyle, before we get started, is there anything top of mind for you that you're excited about on this episode?
Yeah, a multitude of things. Life insurance, it can be a rather morbid topic. Most insurance is you're planning for the worst case, but it is, one of our jobs as financial planners to identify gaps in coverage. And often that can be one of them. The same thing with disability insurance, especially with disability insurance. I have a personal feeling for that one, which is a story we can get into later. But yeah, insurance come in all different shapes and sizes, and depending on what you're looking for, could depend on what type of policy you get.
Yeah. Yeah. And so kind of transitioning into this first part of the conversation, which is life insurance, the ultimate reality is, at least from my personal perspective, I view life insurance as a benefit that is paid out to your family in the event of a premature death, right? You are planning for the thought that you're going to pass away earlier than when you think you are. Now, obviously, nobody knows when they're going to die. But for me, as a 26-year-old person, I think I'm going to live a pretty long life. Now, I'm going to just throw this out there, but my random goal is, I was born in 1997. I want to live to 2100. So I want to die at 103 years old, right? So I got a pretty long time horizon for myself. But you look at the actuarial tables, and it's like, what is it, like 70? It's like 74 and 79, males to females. Women tend to live longer, as probably most of us know, because men, do stupid things. But, but you're essentially buying this insurance because you're planning for the possibility of you passing away earlier, and those proceeds covering your family's cost of life without you. And there's a lot of different ways that we can talk about that as far as how to actually calculate the number. Kyle, I'd be curious to kind of get your take on how you walk, clients through that process, because there's a couple of different iterations in how to do that. And then you're also wanting to choose the vehicle that you want to utilize. And that's kind of where we wanted to hone in is there's really kind of two different types of life insurance vehicles. There's going to be term insurance, and there's going to be permanent insurance. And I'd love to just kind of have you walk everyone through kind of what the differences between those two are.
Yeah, I just want to say I love how you have the 103-year goal. I always think of Ricky Bobby, like, with my high level of income and advances in modern technology, I can't see myself living to 150, 200.
Yeah, easy.
Easy.
I just watched that the other day, actually.
It's a great movie. So yes, as you mentioned, the purpose for insurance can actually have a lot of different flavors, and that's determining the vehicle of insurance you will use will be very much dependent on the purpose you have for the insurance. In my personal opinion, I believe everyone should be insured. Why should I be insured as a 25-year-old? Because it's not free to bury someone, first and foremost. Burial expenses and taking care of that.
On average, it's like $35,000.
35.
Cremation helps a lot. Cremation helps a lot, but if that's the route you want to go, but burial expenses it's costly.
Exactly. And if you didn't have the desire to cremate your child, and all of a sudden you're financially required to do so, that's not something you want to put yourself. So I always encourage people to, even on their children, especially when they go to college or something, get student loans. Like I always say, have minimal life insurance policy there. But again, it could be clear, the reasons for insurance can be very simple. It could be to pay off debts, right? Say I'm 40, I've got a couple kids, and I want to make sure that if I die, that the house can get paid off, that my spouse and my children will be taken care of. They don't have to worry about paying off these debts without any other income. So it could be paying off debts. It could be very simply, like I just said, replacing your income. It could be building a legacy, right? So it could be, I want to fund this policy so that my children have $1 million of extra inheritance tax-free when I pass away. It could be creating estate liquidity, right? So we're going to get into this with business owners, but if you have a massive business or something and you want your children to take it over, there's a big old estate tax or inheritance tax, depending on, the state that you pass away in. And in order to pay for that, sometimes an insurance policy can be really beneficial. So wanted to cover some of the biggest areas before I jumped into the different types, because that's important. Is whenever you're getting into disability, understand why you're getting disability insurance. So let's back up now and go talk about the two different types in our opinion. And the very big buckets of insurance, of life insurance, you really have two types: permanent and term.
Yeah.
Permanent insurance will last until you die or until age 100. Usually if you live beyond age 100, it'll pay you out the cash value. But most of them will pay until you die. So permanent insurance is, you're paying for insurance. I'll come back to permanent insurance. Term insurance is very plain Jane, very straightforward. I will buy $1 million term policy, which is for a set term of time for 20 years, 15, 10, 30. It could be, it's usually 10 to 30 years where I most often see them. With term policies, it is what I refer to as bang for buck insurance. All you are paying for is the insurance. So typically it's cheaper, right? So if I want to go get $1 million policy at my age 25 for 20 years, it might cost me $50. Let's go back to permanent policies, permanent insurance that can come in. You're going to hear so many different names out there. There's all these different types of products. There's whole life, there's universal, there's variable. It can get a little overwhelming if you're not familiar with the space, but it can have a lot of different purposes. Typically your premiums will be much higher, right? Because you're not just paying for the insurance, just like a term policy. You will, in some policies, you can have cash buildup. So, early on, I'm 25 years old. Say I'm paying for insurance, $250,000 policy, it might cost me $1,500. Now, not all that $1,500, because I'm young, is going to the insurance policy. Let's say $1,000 is going to pay for the insurance, 500 is sitting there as cash, and it's actually going to start earning interest and building up. And if you've ever seen a whole life policy, you'll notice that most of them have cash available, right, to surrender.
Yeah.
That's their cash buildup over time, which you'll get an interest rate on, you'll pay taxes on. And yeah, so essentially permanent policies come in a lot of different shapes and sizes, but overall they're typically more expensive because there is a part of the policy that's, you're getting paid out and you're building cash on it. Some people look at it as an investment. I think it's unless you are really overfunding the daylights out of insurance policy, I hesitate to look at it as an investment, but that's my 30,000-foot view.
Yeah. Yeah. And I think the reality on the permanent insurance too is it's a little bit more expensive because it is a policy if you continue to pay premiums that will insure you for life, right? Because the term policy, like you said, it's very plain Jane, it's very simple. And, your cost of coverage is going to be much cheaper than in most circumstances than a permanent policy. If you buy it at, 30 and you buy a 20-year term until you're 50 versus buying a permanent policy at 30, because the actual statistical likelihood of you passing away in that 20-year time frame is pretty low, because all of this is actuarial tables, right? This is what all these life insurance companies are crunching the numbers and figuring that out. And the decision between either going permanent or term really just kind of depends on what your personal values are and what you're truly looking to utilize the insurance for, right? And cost is also a conversation too, because the way that I look at it is, if you're a person who always wants to have insurance coverage regardless of the situation, permanent is probably, a considerable route for you. If you're somebody who is looking to have insurance in kind of the heavy part of your life, which I would consider is like that first part of getting married, having young children. And then once the children are out of the house, they're on their own. Maybe the house is paid off by then as well. You don't necessarily have a lot of what I would call liability exposure from an insurance perspective. You don't have necessarily a lot of debts or anything of that nature, then the term policy is probably a good option for you. But one of the things that you and I kind of talked about that is kind of a hybrid model to these things is having starting with a term policy, maybe doing a 20-year term policy. And then once the policy gets close to maturing at that 20th year, you can obviously do it earlier, but converting that term policy into a permanent policy. Now, this is essentially, and for some reason it's escaping me. What's the word for that? It's you're converting it, right?
Yep. Yep.
Yeah, geez, for some reason it's Friday. Apologies. But this conversion option gives you a little bit more flexibility, because essentially what you're doing is you're getting the cheap insurance while you're young and maybe your income is a little bit lower. And then you're converting it into permanent insurance, which will be more expensive when you're kind of in your higher earning years, so that you can actually cover that. And it's also just a decision that allows you to do that if you want to. If you don't want that, then the policy can just finish after the 20th year and you can kind of go your separate ways.
And I'm glad you brought that up. Depending on your health, if you're in good health and you want to remain insured, you can just get another term policy if you so choose.
That's true.
The thing where I see conversions come into play, and it's very, very important if you have declining health to pay attention to your conversion date, because I've had a lot of clients come in and say, hey, my term policy is about to end. I would like to, consider converting it. And one of the big reasons you want to convert it is because if you already have an existing policy and a term policy and you convert it to whole life insurance, you do not have to prove your insurability again. So whenever you get insurance, you have to prove to the underwriting company that you are insurable. I don't have cancer and I'm not terminally ill today, and they want to insure this. They want, because they've got all this data that they want to make sure that they're going to charge the right amount of premium and all this stuff, right? So essentially, if you have, you get cancer or something in your 40s and your term policy is about to lose its conversion feature, you want to be on that, because you're not going to be able to get a new policy at the rate you got it 20 years ago. So that's the time where if you're declining health and you wouldn't otherwise be able to get new insurance, that's when I always say, let's take a look and see if it's convertible. But again, it comes at a high price. If you're used to paying, I don't know, $100 a month or something, and all of a sudden 20 years later, you convert that, you might get a little sticker shock.
Yeah.
But that's the case. If you want to remain insured, that's what you have to do.
I think it's a great planning opportunity, though. It's, buying that term insurance in a much cheaper fashion when you're younger. And if you experience or incur something like that, where let's just use the cancer example, right? Let's say, you buy the term policy at 30, it's 20 years of term insurance. And let's say at 45, you get diagnosed with cancer, right? Your policy only has 5 years left on it from a term perspective. And you're most likely uninsurable after that cancer diagnosis in the future. So leveraging that option to convert the policy to keep the life insurance in place, because now you really need it, right? Now there's a much higher likelihood of mortality, and you want to recognize, hey, I can convert this policy and keep it active on a whole life basis or on a permanent basis. I am going to pay higher premiums, but my family's probably going to need that death benefit. And the fact that you don't have to reprove your insurability is important. Now, one of the things to recognize, just kind of a small detail, is you don't necessarily have to prove you're insurable, but what they will do is they'll calculate the premium off of the age in which you convert. So if you bought it at 30 and converted at 47, right, they're going to take the premium costs at your rate class for your health profile when you did at 30 at 47. They're not just going to take it at 30. That's a question that I've gotten asked a few times. So I just kind of wanted to highlight that.
Yeah, it's a good point. And before we move on to so we've talked about what the types of insurance are there. Now, another thing I've seen is when people are either underinsured, which is more common than when they're overinsured. And it's a question we get a lot, and there's no black or white answer as to determine the right amount of coverage, right? So when you do decide to get either term or permanent life insurance policy, the next reasonable question is, well, how much should I get? And there's a couple of different approaches. I'm not going to get into the calculations on them because they can be rather complex, but there's some approaches called the human life value approach, in which case you'll take a look at how much someone's earning, You'll, depending on their age, you'll multiply it out. Say for me, I'm going to earn 100 grand for 30 years. That means I need a $3 million policy, and you can get the present value of it. So you can reduce it. So it's 2 million today. And that's one of the ways. So you can look at how much you're making to replace your income. The other one is to look at your capital needs. So a capital needs approach is taking a look at all your debts, saying if I was to pass away with my current level of spending, where do we project if I was to pass away that my spouse and my family will continue spending at? And how much do they need to pay off their debts and continue spending at that level? So, you start getting the calculations. Are they going to get Social Security, disability, or survivor? You start looking at all their income. Are they going to work in the future? But there's ways to do it. So I always try and keep it simple, right?
Yeah.
One, find out why you're getting insurance. That makes it a lot easier. Two, which type of insurance vehicle we're going to use, term or permanent. And three, determining how much. Well, if you just want to pay off debts, let's take a look at how much your mortgage is, how much your car loans are. If you have future education expenses, let's talk about that. And we kind of just figure out this number. And usually we go a little bit higher because you'd rather be overinsured than underinsured.
Yeah. And I think that's where the capital needs approach, kind of what you were outlining right there, is it's a lot more personal. And it actually takes into consideration your thoughts and the values and the situations that are going on in your life. It definitely provides a lot more of a holistic view on what your insurance need is, compared to just kind of taking this income number and, projecting it out over a certain period of time.
Exactly. And anything finance, you want it to be as personalized as possible. And I think that's a more personalized approach, just because you don't know in the future what you want your lifestyle to be like in the future, if you're anticipating bonuses and raises. So human life value doesn't account for that. I think the capital needs is the most common one that I use and have those discussions with clients.
Yeah, for sure. So kind of moving on to the disability side, we're kind of shifting the thought on risk of mortality to risk of injury, right? Loss of income. And there's some staggering stats that we'll kind of dive into here in a bit. But the reality is about 25% of people in their 20s and 30s right now are going to experience some sort of disability before they retire. Like that's just the honest truth. Now, this is including both blue and white collar, professions. So all of these things can happen. And a lot of the disabilities that are incurred, I can pull up the stat here in a minute, but the disabilities that are incurred, a majority of them are non-work related, which I think is really important to consider, right? Is, let's take me for an example, right? I work in an office every day. What are the odds that I'm going to
nasty paper cut?
Yeah, exactly. I'm on the injured list for a month, right? And the reality is a lot of these injuries that cause short or long-term disability are happening outside of the workplace, right? So you just need to recognize it's not necessarily about the safety or the safety of your job. It's about kind of what your outside lifestyle looks like, and protecting your income if something like that were to occur. Because I was just talking to you about this offline, but a 2019 study showed that 78% of bankruptcies occurred because of a loss of income. And I think it was 45% of those cases were due to cancer. Right? So that's not even technically an injury, right? You were diagnosed with cancer, you couldn't work, you lost your income, and the overwhelming cost of that medical issue caused you to go bankrupt. Now, I'm not saying that if you just buy some disability insurance, that will take care of everything. It won't, right? But having these things in place on the short and the long term can provide so much help financially to prevent some of those things from happening.
Yep. And the stat I wanted to throw in before was only 10% of disabilities occur in the workplace, which is typically covered by workers' comp if you have that policy anyway.
Yeah. Almost, especially any blue collar jobs are definitely going to have workers' comp on it.
Yep.
Go ahead.
And starting off with, disability or even life insurance, it's always good to check on your employee benefits, especially if you work in a large corporation. A lot of the times they will offer life insurance, at a multiple of your salary for life insurance. Sometimes they'll offer disability up to 60% of your salary. So before we wanted to kick that off, I just wanted to say that just to make sure if you're listening, go and you're unsure of what your coverage is, you can go check that out in your employee handbook.
Yeah. And most of the time, especially at large companies like you were talking about, you're going to get just kind of like your base $50,000 term policy. Now, the reality is, excuse me, that policy that you have at your job is not what's called portable. So if you leave that job, unless your new job has that same type of a policy, you could possibly walk away from that coverage, right? Even from a multiples of salary. So just kind of an example to explain that is let's say that this company, XYZ company that you work for offers a 3 times multiple of your salary as a death benefit for term coverage while you're an employee. Let's say you make $100,000, right? So you have 300,000 in coverage. You're like, oh, this is the right amount of coverage for me in my specific situation. Let's say you leave your job and you go to a new job that maybe provides just a flat $50,000 term policy, right? So they don't do a multiple of income. You get married and you have 2 kids within the first 3 years you have in that job. The reality is there's a very high likelihood that you are pretty heavily underinsured and you didn't take that into effect. You didn't factor that situation. So especially when you're changing jobs, kind of reevaluating what your insurance coverage is important.
Yep. And then before we get into, because we're on the note, disability, if you have it through work, you usually have the opportunity to pay for it before or after taxes. So you can get a deduction or not. And I just wanted to say this out front. If you have that choice, I always recommend paying it, or more often than not, I should say, I more often than not recommend paying it after tax. Because if you pay it after tax, it might cost you more upfront and you might not get the deduction today. But if you ever need those benefits, if you ever lose your income and you're relying on disability, do you want to pay taxes on your disability income or not at a time when you already have reduced income, right? So if you get the deduction up front, that means you're going to be paying taxes on the back end. If you do not get the deduction up front, you pay after tax, you get those benefits tax-free. So want to throw that out there before we even jumped into the specifics of disability.
Well, and that's really important too, because one of the things that a lot of people don't recognize about disability insurance is they're normally only providing the benefit as a percentage of your income. And it's normally anywhere from 60 to 70%, right? So if let's just be conservative and let's say that you're getting 70% income coverage through your disability policy. And you do the pre-tax election, the before tax election. And so you incur a disability, you file a claim and you start receiving benefits. Well, you're going to be paying taxes on those benefits. And so your 70% is, let's call it now, 65%. Right. And that's when you really need those extra dollars. And so I think that's a really important consideration to make.
Exactly. Yep. So ready to just jump in?
On the disability?
On the disability, yeah. So
sorry, I kind of drew a blank there. We're already kind of midway through.
Sorry about that. So let's talk about disability insurance because it's not as plain Jane as term insurance was. Disability can have a lot of different shapes and flavors, and namely your profession and your industry can greatly have a cost and have a difference on the cost of your disability.
Yeah.
Because Thomas, you mentioned the 2 of us working in office. What are the chances I disable myself working in the office? No, like the highest likelihood of disability for someone like us, like you mentioned, is cancer, heart attack, stroke, kidney, all these other things not related to something that happens in the office, right? So we got pretty good premiums. Who gets really good premiums? Doctors get really good premiums. Lawyers get, white collar workers get really good premiums. I went through the process of trying to get a mechanic disability insurance. Mechanics have it's a much more dangerous job than we have, that's for sure. They're dealing with heavy equipment. You never know what could happen. You can break an arm, something could fall on you, break a leg. So a mechanic, a blue collar worker as a whole, will have I don't want to say a harder time, but it'll be much more expensive to insure them because your risk, the likelihood of you becoming disabled is much higher, at least in the workplace.
Yeah.
So there's a big cost difference in there. And then one other thing, when they do the underwriting for disability, I always thought this was funny. If you ever get a disability insurance policy, it's going to say somewhere in there that there are exclusions that if you get disabled for these reasons, we're not paying you. And it's like skydiving, scuba diving, mountain climbing, like they'll have these extremes. So if you are into extreme sports, you're going to have to disclose that and they're not going to cover you for it. So I figured I'd throw that out there too.
Yeah, it's important. And kind of recognizing too, there's really 2 different types of disability. And depending on how ironclad you want your insurance coverage to be, recognizing these differences is important. Is there's short-term disability and there's long-term disability. And essentially kind of what you're looking at there is short-term is 6 months or less. Kyle, correct me if I'm wrong. And long-term is essentially a year plus. And so just kind of recognizing, depending on your occupation, the recreational activities that you engage in, if having both is important. I think for the most part, both is important for about anybody, because if you incur a short-term disability, there's a chance that if you don't have short-term coverage, you should be okay. But if you incur a long-term disability where you can no longer work for 1, 10, 15, maybe even the rest of your life, that loss of income is much more drastically important, right? And so the long-term coverage, in my opinion, is almost more important. Now, the likelihood is lower, but it's a transfer of risk, right? You're transferring that risk to the insurance company by having that disability coverage, and you're paying the premiums through that. But recognizing that there's kind of two different options there. And the reality is at most large companies too, you're going to have the option to do both. But just kind of recognizing the benefits and the costs are super important.
I'm glad you brought that up because I would have forgotten to mention this. There's a lot of different layers of the onion of disability insurance, but another important one on top of that is when you're coordinating short and long-term disability, if you do have both policies, it's important to understand what your elimination period is on those coverages. And your elimination period means how long do you need to be disabled before you start getting paid out? Short-term disability is typically 6 weeks. So you have to be disabled for 6 weeks, and then they'll start paying you out until 180 days. And then typically, if you have long-term disability, you get elimination periods in which you can choose your elimination period. And usually it's 90 days, 180 days, 365 days. So I can say if I'm injured for a quarter of the year, 3 months, I want to start getting paid. That insurance will cost more than if I choose the 365-day option, because I have to be disabled a whole year before I get paid. The likelihood of that is far less than just 3 months. So another thing to consider there is it'll cost you more if you have a lower elimination period, which means you get paid quicker. So just want to throw that there, because what I do when I coordinate short and long-term disability is if you have short-term disability that's going to pay you for 180 days, I'm going to set the long-term disability for 100, or the elimination period on the long-term policy for 180 days. So there's no lapse in payments.
Yeah. And you're kind of laddering it out, right? It's like you're using the short-term coverage to take care of that. And then the long-term coverage will set in right as the short-term ends.
Exactly.
And that's super important. I appreciate you bringing that up.
Yep. Yeah, it stemmed off you. So one last thing that I'd throw in here is, again, everyone knows there's so many statistics out there, but disability insurance, not having disability insurance can be devastating. The same way not having life insurance can. If you pass away early, and you're in your 40s, 50s, and you're your prime earner, your prime breadwinner in your family, and you pass away, where's that income coming from? They're gonna have to adjust their lifestyle. Disability can even be worse. Me personally, my father had a stroke a few years ago and he hasn't been able to work, no disability insurance. It just completely changes your lifestyle. You start going on Social Security disability, you start going to CPT, and you start doing all these things and your income's less. So it can have, some serious adverse financial effects. And when it comes to insurance, I hate this word, but I always tell people, don't be cheap with insurance. At least get the minimum you need to make sure that you're okay in this worst case event, because it won't happen to me. It does.
Yeah, for sure. And I think that kind of recognizing this too is you'll also want to kind of look at some of the elimination periods, especially on the short-term disability, and kind of relate that over to what your emergency fund looks like. I know we're kind of jumping past here, but that's also kind of a good strategy too, because one of the stats that I was going to throw out there is, kind of 2019 study again, 40% of US households, they had enough savings for 3 months of expense coverage, right? So only 40% of US households have a 3-month emergency fund. And, it's like 28% can do 6 months or over. And so just recognizing that can also kind of play into this as, a little bit of a buffer from an emergency fund perspective, and trying to, ladder those things where it's almost like emergency fund, short-term disability, long-term disability, so that each thing kicks in when the other is exhausted. That's a really good strategy there.
I love that. Yep. Thank you. I just took it a step further.
Yeah. So kind of transitioning to the last part, and we're going to be kind of quick about this one, but looking at the disability side in particular, we've already kind of talked about the insurance side for business owners, but looking at the disability side for business owners, this is really important, because there's kind of two different ways that you can go about this that kind of carries coverage for two different types, two different parts of your business, is looking at an income coverage from a disability perspective, but also an overhead expense coverage if you're disabled. So kind of the crappy thing about disability coverage for business owners is they normally require you to look at the net income number, right? The salary, the net income number, depending on how your business is set up. And that's normally going to be kind of the last line item for a business owner, right? It's normally going to be a lot smaller. So from a income coverage perspective, disability insurance focuses on that kind of smaller net income number. So I would say you're kind of slided a little bit on that. But the second part is business overhead expense insurance, which essentially says if you become disabled, they're going to evaluate what your overhead expenses are on average per month, and they're going to provide disability coverage for those overhead expenses. Because as a business owner, one of the things that I highlight the most is payroll, right? If you have employees, if you get injured and you can no longer bring more money in, your employees still need to get paid, right? And so that's a major overhead expense that if you don't have coverage to pay for that, if you're if you're injured and you're the one that's primarily bringing in the income to the company, that's a major liability.
Yep. You can also get a disability buyout where, say you and your partner and one of you gets disabled, the other person gets paid out to buy your half of the business, if you will, and potentially, you can get key man insurance to replace it. So yeah, you can get, especially with business owners, you can get really, really specific in protecting your gaps of coverage.
Yeah. Yeah. And I think the thing, especially on the business owner side, is being a lot more cognizant from a year-to-year basis on what your disability coverage is, because you might have 100,000 in overhead expenses when you first buy the policy. 7 years down the line, it could be 800,000 in overhead expenses, right? So you'd have a major shortfall as the business grows and evolves and continues to bring in more income, have more overhead, more employees, more payroll. You could essentially kind of put yourself in a pretty tough position if you're not updating and reviewing those insurance policies, for sure.
Yep.
Perfect. Well,
we wrapped it up.
Yeah. So just kind of like summarizing the episode here, just kind of wanted to highlight the differences in life insurance coverage options, kind of at more of a generic level between term and permanent insurance, evaluating what your options are for disability coverage if you're injured and you have a loss of income. And then kind of also looking at it from the business owner side. A lot of these things are not talked about when you grow up. They're not talked about at your job, right? So just recognizing that this is one of the value add components of working with an advisor, right? Because I'm sure you could Google, hey, what should I do for my disability insurance coverage? You get a million different options, right? Having somebody that you can sit down with and figure out based off of your specific situation what's best for you is always going to, it's almost always going to yield the best results. So we just kind of wanted to put this episode as a bit of a flyer to recognize that there's a lot of options, and advisors are normally going to be the people that can help you kind of figure out what the best option is for you.
Yep.
Perfect. Well, thank you to everybody that's watching and listening. We really appreciate it, and we look forward to the next episode.